Want to know how to invest during a recession? To know how to do that, we first have to know what a recession is. A recession is typically defined as a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. What's often left out of this definition is that a true recession is accompanied by a significant rise in unemployment. Put simply, a recession is when the economy slows down as people start spending less money and companies scale back their hiring. This can be a difficult time for investors because stock prices tend to go down when people are buying less. Investing into downward momentum can be dangerous for your portfolio. However, there are still plenty of opportunities to make money during a recession. Here are some tips on how to do it. Number 1. Cash is king. Economic recessions usually coincide with a steady drop in value across markets. This is known as a bear market. This has led to the idea that cash is king. Your flat currency tends to hold value during a bear market because it remains relatively steady as investments keep falling. Now, this doesn't mean that you need to go sell all of your holdings. Don't let a recession shake you out of the market. Instead, lean into your recession-proof skills and use your day job and other revenue streams to generate more cash to invest with. Keep a portion of your portfolio in cash or a money market mutual fund with high liquidity to take advantage of opportunities as they arise. Number 2. Look for companies that are doing well despite the recession. You'll want to shift your portfolio into companies that can weather the storm until the market turns around. There will always be some companies that are doing well even when the economy is struggling. Companies that sell necessities like food and medicine tend to do well during a recession because people still need to buy these things even when they're not spending money on other things. For example, Walmart posted positive returns during the 2008 bear market and quickly recouped its losses from the COVID crash as people scrambled to stock up for isolation. Look for these blue-chip companies that sell recession-proof essentials. Number 3. Look for companies with low debt levels. Debt is often one of the first things that investors look at when choosing stocks, but it's especially important during a recession. Companies with low levels of debt are more likely to weather a recession because they don't have as many financial obligations. As a result, their stock prices are less likely to be affected by the economic downturn. Companies with high levels of debt, on the other hand, might have trouble paying off their debt as cash flows slow down. Number 4. Look for companies with high dividend yields. Dividend yields indicate how much income you can expect to receive from owning a stock. During a recession, companies often cut their dividends in order to save money. However, some companies continue paying high dividends even during a recession. These companies usually have strong cash flows and are less likely to be affected by an economic downturn. For instance, Flour Foods, FLO, has been around since 1919 and offers a dividend of 3.13% at the time of this video. This type of investment combines the benefits of being recession-resistant with the added benefit of a steady dividend for investors. Number 5. Wait for risk assets to bottom. Risk assets are assets that have a high degree of volatility in their price and generally lose value during a recession. These include high-yield bonds, commodities, equities, currencies, and real estate. While risky, buying these assets near the cycle bottom can yield life-changing gains when the economy rebounds. No one knows for certain when the market will bottom, and trying to time a downtrend is like trying to catch a falling knife. Instead, dollar cost average (DCA) into risk assets when prices are down to protect yourself from price fluctuation. This simply means that you invest a fixed amount at regular intervals instead of trying to time the market. For instance, you can start investing $100 into Bitcoin every week as its price starts to level off. Save this strategy for the midpoint of the recession to protect your investment from the brutal drops in price. Number 6. Finally, don't panic. When a recession starts unexpectedly, people start to panic. This leads to poor decision-making. Remaining calm and taking things one day at a time will help you turn the unexpected challenge into an opportunity. Let's recap your recession investment strategy. Number 1. Cash is king. Keep cash on the side to protect yourself from downward momentum and take advantage of lower prices down the line. Number 2. Invest in proven companies that sell essentials. Invest in companies that have proven to do well, regardless of the larger market conditions. Number 3. Invest in companies with low debt levels. Companies with lower levels of debt are less reliant on short-term cash flows. Number 4. Invest in companies that maintain high dividend yields. Dividends can help offset falling stock prices during a recession. Number 5. Wait for risk assets to bottom. You don't want to invest in high-risk assets at the start of a recession. Wait for prices to drop and then dollar-cost average for better returns. Number 6. Don't panic. Remain calm. Do your research and don't act on emotion. You've got this. Investing during a recession can be tricky, but it's still possible to make money if you know where to look. By following these tips, you'll be in a good position to weather the recession and thrive when the storm clears. Remember to do your own research and never invest more than you can afford to lose.